Hi, my name's Cole.
My name's Ryan, and we're your financial advisors, and we're here to talk to you today about your recent activity in your portfolio. So, as you can see, you've lost about $16,000 in the past 3 months, which that's not good. Of course, nobody likes to lose money, but we're here to talk to you about exactly why that happened. So, I'll pass it off to Cole to talk about the different types of investments.
So, what we've bought are stocks. Stocks is where you're going to invest in a specific company. Stocks are typically pretty risky because you're basing your investment solely off of one company. Um, it's very important to diversify when you're into stocks, which is what we've done. That's why we own Twitter and Google and JP Morgan and companies from all across the industry. Bonds are a little bit like stocks, and where you can invest in a certain company. You can also invest in a certain government, state government, federal government. They're not going to provide you as much of a return, but they're also much less risky. There's mutual funds, which are a collection of stocks, typically divided by sector, or the S&P 500, or the Nasdaq. These are going to be a lot less risky, but there's still obviously the risk for a stock market crash where you'll lose a significant portion of money. You can also buy CDs or put your money into a savings account, which is definitely a safe investment, but the returns on these accounts are very minimal. And when you're saving for retirement, you want to make sure you have enough money. And oftentimes, these types of investments won't provide the amount of money that you need.
Right. So, as Cole was saying, we're trying to save for retirement here, and so we wanted to talk to you about how your portfolio currently is 100% in stocks. So usually when saving for retirement, we try to limit our risk as much as possible. And right now, your portfolio does have a lot of possible upside, but it also has a lot of possible downside because you're so heavily invested in stocks. So what we want to try to do over the following months is move your portfolio more towards bonds, ETFs, mutual funds, in addition to just stocks. Um,
So, another thing is the time that you've been in the market. 3 months in the stock market is not a long time at all. There's a lot that could happen in 3 months, and there's a lot that can happen over 10 years to that money. If you lose 10%, which is about what we've lost right now, you can easily make that back within a year. So, just long-term investing is important. Your retirement's still a decent amount away, and the general trend of the market is going to be up. So over time, if you keep your money in for 10 or 15 years, you're going to eventually make some money on your investments.
right. And that's sort of what we have to remember here is that it is not fun to lose money, of course, but it's been 3 months and our investment strategy relies on years and years of time in the market. So the longer we stay in, the better chance you have of making money. And that kind of brings us to you wanting to move all your money to a savings account. We would strongly advise against doing that for a few reasons. Cole, do you want to talk about that?
Yeah, so a savings account is, as I said, a very safe investment, but on average, you're going to be making 0 to 2% a year on your investment, which is very low compared to the stock market or bonds or mutual funds. And you're not going to be saving for retirement really in any way. You're going to be losing money every year because of inflation, as it's currently moving faster than what a savings account will provide for you. So it's we would suggest putting your money into an array of stocks, bonds, mutual funds, and some into savings accounts. We'll obviously put some in there, but putting all of it in is certainly risky, not in the way of the investment, but in the way of having money later on in your account.
Mhm. And so, sort of the advantage to doing what Cole was talking about, diversifying to bonds, mutual funds, ETFs, CDs, in addition to just purely stocks, is that your portfolio is a lot more is a lot less affected by movement in the market. So currently, if the market has a red day, you will lose money because are 100% invested in stocks. However, if we're able to move a portion of your portfolio to different types of investments, you'll be a lot less affected by movement in the market, which is good. That's what we want for a retirement
Yeah,
fund.
that's exactly right. And so, as you can see from our balance sheet of all the companies that we own, pretty much everything that we have bought is in the red, which is a good indicator that the market as a general is in a red because we're not invested in just technology or just banking companies. We are invested across the whole market. We have social media, we have technology, we have banking, we have restaurants, we have auto dealers. And if all of them are down, more than likely, any kind of investment in the stock market is going to be down as well with it. So I think that's just important to know and to understand that it wasn't necessarily us picking the wrong companies for a stock, as even over 3 months, who knows what's going to happen to a stock. It's important to stay in that stock for a long time.
Exactly. The one thing we know about the stock market is that stocks do tend to trend upward over time, which is why, again, it's important to keep your money in for as long as you can. Because while the past 3 months you have lost money, if you give it time, you will start to see a return, especially if we diversify. So,
Yeah,
uh,
that's exactly right. And I just wanted to say one more time before we end our meeting with you is risk versus reward. In the stock market, we took a pretty big risk by putting all of that money into there, and we lost on that investment so far. Who knows what'll happen in the next 6 months or a year? But the possibility of making a bigger return on our investment was not super high, but we also had a chance of making it earn you $16,000 in the past 3 months. If you were to put it all into savings accounts, you're going to make 2% at most consistently every year, which isn't necessarily a bad thing. But when you're saving for retirement, it's important to have that growth throughout all the your time investing. So I'll hand it off to Ryan to say any other last things, but otherwise, thank you.
yeah, just to recap real quick, like Cole said, the most important thing with a retirement fund is we want to see growth over time. And yes, there will be movement in both directions, but as long as you keep your money in for a long time, you will see growth. And you will not see that if you put it in a savings account. So we hope that you'll keep your money with us. And
Yeah, and we'll try to make it back for you in our plan for diversification into other stocks, bonds, mutual funds. And I hope you can allow us to do this with your money because we really want to do what's best for you. We didn't try to lose you any money. But thank you. Have a good day, and we hope we listen. And we hope you listen to us. Yeah,
thank you.
thank you for your time.